Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get you the headlines. Indian equities recover from the morning's losses to trade over 0.5% higher. The rupee appreciates 0.33%, while bond yields ease to 6.75. The US Federal Reserve chooses to stay put on interest rates but leaves the door open for a rate cut in the near future. The government is considering an increase in the personal income tax threshold to 3 lakhs from the current 2.5 lakhs in next month's budget. That's a Bloomberg News exclusive. HDFC will purchase 51.2% stake in Apollo Munich Health Insurance for over 1,300 crore rupees. The merger process will be completed in 2 steps. All right, all those stories coming up in a bit, but let's start with the markets. Yatin is here with us. Afternoon, Yatin.
Afternoon, Ira, and second days of gains coming in as far as the markets are concerned. Of course, the breadth remains extremely weak as far as the broader market is concerned. But if you look at the Nifty 50 at this point in time, almost 4 stocks advancing to 1 declining. On the gaining side, we have the entire private sector banking space as well as the housing finance space, which is bouncing back in the NBFC side. Individual Housing Finance being the top gainer, 6% up for that one. Yes Bank and IndusInd Bank are also the ones which are gaining smartly in trade. In the pharma pack, we do have Sun Pharma, which is gaining by almost 4% after the recent correction that we saw in the stock. Also, on the losing side, we have UPL, which has continued to slide. Remember, that stock is almost down 15% in the last few trading sessions. Today, the stock is down nearly 10%, trading near that 850 rupees mark. Adani Port goes ex buyback along with Wipro. Both of these stocks, despite adjustment in prices, have seen some sell-off coming in. Tech Mahindra and Britannia are also the ones which are losing in trade. In terms of active security, HDFC posts the transaction with Apollo Munich, in order to buy their insurance business is active. That stock is up 1.5%. Jain Irrigation, after the beating that it took last week and this week, is bouncing back 20% up for that one. Jet Airways has also looked at some bounce back, which is coming in. Fierce short covering seen here ahead of expiry next week. That stock is up nearly 26% in trade.
Yatin, thanks so much for that. The big global news, of course, is the US Federal Reserve. They kept their interest rates on hold, contrary to market expectations. However, the world's most powerful central bank has chosen to drop the word patient from its approach, hinting at a possible rate cut later in the year. Perhaps Kathleen Hayes reports.
Well, it certainly shows they're not ready to pull the trigger yet on rate cuts. Nevertheless, let's look at some of the things that just sent that signal quite apart from the dots, because the Fed dropped the word, the patient approach, to be patient on rates. That's no longer there. They also, on the other hand, talking about why not moving now, Jay Powell talked about, well, there's, we saw stronger retail sales, there's strength in consumer spending. The labor market still looks pretty good, but he also talked about cross currents, low inflation. They had to drop their inflation forecast for this year on the consensus from 1.8% to 1.5%, further from the 2% target. Trade war, weaker overseas growth. And let's look at the dot plot now, because that's what really drives home this new dovish stance. What you can see on the far right-hand side of your screen is that in from the left, that's the March meeting. See that long yellow line? Now we can see it even better. Then you can see the consensus was just hold steady. We don't know what we're going to do. Then you move over to the far right, and now you see there's fewer people holding steady. Down below, there's 8 that are looking for a rate cut this year. And in fact, Jay Powell, when asked at the press conference, said even the people who stayed steady, they didn't say we're ready to cut yet, they're still leading in that direction.
The projections of appropriate policy show that many participants believe that some cut in the federal funds rate will be appropriate in the scenario that they see as most likely. Though some participants wrote down policy cuts and others did not, our deliberations made clear that a number of those who wrote down a flat rate path agree that the case for additional accommodation has strengthened since our May meeting.
Clearly, the Fed chair went out of his way to make sure people realize that even what we saw in those dots is even more dovish maybe than you might think on the surface. All the more reason why markets are pricing in a rate cut, at least 25 basis points when they meet in July.
The bond market may be running ahead of the curve, says Selina Ling, the head of Treasury at OCBC Bank, speaking to Bloomberg News. Selina says the market participants are factoring in a 75 basis point cut in this year alone, while most FOMC members have hinted at a maximum of 50 basis point cuts in 2020. Listen in.
if you look at what the futures market has priced in, it essentially is up to a 75 basis point for the Fed. Actually, looking at the dots plot, they are kind of like moving lower, but it's probably not as dovish as what Powell seems to suggest in his Q&A. I mean, the signal is clear. They want to be precautionary, right? Because he said that 1 ounce of prevention is better than a pound of care. So I think what we're looking at now is probably an earlier than expected rate cut, possibly in the third quarter rather than the fourth quarter, which was what we initially expected. But I think the biggest question is who else is to follow, and we have already seen RBA essentially capitulating as well.
Yeah, well, we heard from RBA's Lowe just a couple of moments ago in Adelaide, basically saying not unrealistic for another cut. That kind of reiterated what we'd seen from the June meeting minutes as well. So it is likely that we are seeing this more dovish tilt coming through from central banks. Is the bond market, though, ahead of the curve, because you have seen this big move coming through in yields on the 10-year?
Yes, I think we may be getting a little bit ahead of ourselves. I think a lot of the gains have already been priced in. If you look at where the 2-year and the 10-year Treasury yields are currently headed, I mean, if you look at the dots plot and if you put some credibility to where the 2020 numbers are at, essentially you have 9 members of the FOMC calling for 25 to 50 basis point cuts, nowhere near the 75 basis point that's already priced in for this year alone. So, it could be a sense that, if they cut 25, at most 50 this year, they may be done actually for 2020. So I don't think we are looking at 75 or anything beyond the 75 basis point cut that's already priced into the market.
Sydney, I just want to get to the comment that Jay Powell did make about prevention being better than the cure. So are they in effect trying to get ahead of it? Are they trying to get ahead of where the economy is? Because they're data dependent, and data, of course, is backward looking. So ultimately, it's perhaps all these concerns about the trade war. Perhaps this will be reflected in the earnings season just about to kick off in a couple of weeks. So they're looking at that. So they are not being data dependent effectively, are they?
Actually, no, because if you look at the tweaks to the economic assessment, growth remains fairly healthy. They actually adjusted 2020 growth expectations up. They only adjusted the unemployment and the core PCE forecast down a little bit. So, essentially they are saying the trade tensions basically have heightened uncertainties, and that's giving them the cue to cut. In addition to that, inflation numbers haven't come in as strong as expected. So essentially these two are the main factors that they are pushing ahead. I think we have to also be cognizant that I think political pressure to a certain extent probably has pushed them into a corner where they will actually have to to cut preemptively rather than what they're comfortable with. So it's not an issue about data dependency anymore.
All right, back home in India, the bond markets have reacted to global triggers as well as some possible local triggers. The 10-year bond yield has been falling sharply. It's trading at 676 this morning. How is all of this global change going to work out for the domestic markets? Tushar Arora, senior economist at HDFC Bank, is joining me. Tushar, thanks for taking the time. It's the downtick that we've seen in domestic yields has been broadly on the back of global yields so far, would you say?
Well, I think today's reaction has been in the backdrop of what the Fed change in stance was last night. Before this, I think markets had been reacting to whatever the RBI has been doing. But today it seems like it is more to do with Fed.
How do you think, Tushar, this whole story is going to play out for India? Because so far, the money has been coming in to India for sure, even on the bond market side. There isn't that level of risk aversion that you would expect outflows. So as things stand right now, the turn in the global environment with monetary policy turning softer, more accommodative, should be beneficial for India?
Well, I think there are two things here to note. One is how market perception changes. If the market tends to believe that this is more of a risk-off scenario, what I mean here is, what markets start believing is that the Fed is cutting rates because they see a slowdown coming in, and this is a scenario which would pan out globally and everybody would be worried about slowdown. In that case, the flows could, moderate a little bit, in fact. But if markets tend to believe that, this Fed rate cut would be supportive of global momentum and this would bring back growth in the economy, this could encourage, in fact, more flows coming in the economy. So I think it's too early to judge because markets actually behave in a weird fashion at times. And I think whether the risk of people would win or whether the risk on people would win, that would be yet to see. And there's something which is quite happening today in the FX market. It's my FX side, things are not really able to find direction. But in the bond market, I think it's quite clear that yields are going down and the reaction would be supportive for the bond investors. From the RBI side, I think the rate cut for August is quite penciled in, so there is no major scope from that angle. If the US worries escalate from here on, if the trade tensions escalate here on, then I think globally yields could dip a little more, and that could have a favorable impact on Indian bond yields as well. But as of now, I think 6.75 is something which we see as the levels to book profit in the market.
Tushar, so it's actually interesting the way bond markets is reacting and the way currency market is reacting, as you said. And if you look at the currency market and the gold market in conjunction, they seem to be suggesting that this situation could worsen and there could be more and more fears, which is probably what is pushing people into gold. If that were to materialize, then it becomes negative all round, right? Because flows would turn.
Yes, exactly. I think if risk off is really something which everybody would tend to go for, and if the global slowdown worries escalate from here on, and in that kind of a scenario, the safe haven assets really tend to gain more, like you mentioned, gold or bonds in general. In bonds also, I think people would start differentiating between internationally safe haven bonds like US or going into Japanese assets. So as of now, I think that trend has not started yet. As of now, people are still, buying emerging market bonds, and India is quite gaining out of it. But if slowdown really escalates and if these worries escalate, then I think global fund managers would start differentiating between EMs and DMs as well, and they would start going towards safe haven, back to US and back to Japan, I think.
Tushar, last word, start watching gold a little bit more than we have in the past. I mean, longer period of time, we keep having periods where gold and gold imports become a problem. I don't know if that's the case right now, but something that we need to watch?
Yes, in fact, gold import numbers have been going up for past number of readings. That is a trend to watch out for. But, having said that, I think globally situation is not that bad also. I think even if you go by the US Fed estimates, they are not really revised down their growth estimates. It is just the comfort that they're getting on inflation and these, trade-related tensions which they're, thinking of to support the economy for. So I think it's not a recession-like scenario which is panning out globally that gold prices would really skyrocket and, we'll see a very major movement towards gold. Yes, there is a slowdown and we need to be watchful of that. But it is, end of the day, a slowdown, not a recession in my view.
True that. Tushar, thanks so much for your perspective. Always good to talk to you. That's how the global scenario is playing out on domestic bonds, FX, and perhaps the bullion markets as well. Let's move on to news. The government is considering an increase in the personal income tax threshold in the next month's budget. People familiar with the matter have told Bloomberg News authorities are seeking to kickstart consumption in the economy. Rishti Beniwal joins us from Delhi with the details. Rishti, what have you picked up?
Okay. So it's time to reward voters after a major election win last month. And also, the government is trying to give a boost to the economy by putting more money in pockets of taxpayers. So that's killing two birds with one stone. As part of budget discussions, which will be presented by Finance Minister Nirmala Sitharaman on July 5, what they are discussing is increasing the tax exemption limit by 50,000 to 3 lakh rupees for all individuals. So remember, in February budget, they had given some tax relief to taxpayers who are earning less than that, but now it will be expanded to all individuals. So this benefit translates into 2,500 rupees a year, which is not much, but the finance industry needs to be mindful of its fiscal deficit also. They have projected a target of 3.4%. We have to see whether that target will be maintained or it will be widened to pay for all these expenses. So that's and another proposal that is being considered is to raise the standard deduction limit under Section 80C of Income Tax Act from current 1,50,000 rupees. So all these measures can give a boost to economy and help lift the economy, which is growing at the slowest pace in 5 years. Back to you.
Rishti, thanks so much for bringing that to us. India's push to quickly expand its corporate debt market is faltering. Borrowers are turning more and more towards banks, already struggling with stressed assets. Bloomberg's Rahul Satija joins us with what the Bloomberg Economics Index is showing. Rahul, what are the numbers looking like?
Thanks, Shira. So what we are seeing is while the outstanding corporate rupee notes is expanding for years, the pace of growth has slowed down to the lowest in a decade in May. This is basically reflecting the mood in the market, where investors have been on the edge since the default of ILNFS last year. And the risk that this crisis is spreading among shadow banks has resurfaced recently with the number of downgrades we are seeing, starting from Divan to Reliance Capital.
So what are the numbers now looking like? What are the kind of growth rates in the outstanding numbers?
Yes, so we are looking at 9.7% in May, which is the lowest in a decade.
Rahul, thanks so much for that. The RBI's new circular on stressed asset resolution has made it mandatory for all lenders to enter into an intercreditor agreement within 30 days of a corporate default. The Indian Banks Association has circulated a draft set of that intercreditor agreement. Advait Rao Palapu is joining us with the details of what that creditor agreement entails. Adit.
Sure. So just to put some context, the RBI had come out with a circular last February on the stressed asset resolution framework. Essentially, that framework got diluted and is now reissued under the June 7th framework that was released last week by the RBI. The Supreme Court essentially struck it down, saying that the one-day default rule was too indiscriminate. The companies across sectors were pushed into the insolvency and bankruptcy court proceedings. So the Indian Banks Association has now come up with a draft of the intercreditor agreement, essentially saying that under the new RBI circular, banks will have around 30 days to review a corporate defaulter's account to see whether there is a realizable value, what the recovery value is, and to see whether they can actually restructure the account or revive the company underneath, and also recover some of their outstanding dues. So under the ICA agreement, all the lenders will have to sign on. Right now, the draft that we have is only for banks. It is expected that NBFCs, asset reconstruction companies, and sort of developing companies will also sign on, but some legal sources have said that they would not sign on because the 180-day period to resolve an account is too long, and because there's a sort of moratorium on the lenders signing the agreement from invoking some of the securities that were given by the borrower against their debt. They might be stuck with their sort of exposure with this under the ICA agreement. So under the ICA at the moment, the majority of lenders will have to approve a plan, and the majority is defined as 75% based on the exposure or 60% based on the number of lenders in the agreement. More than that, once the lead lender is appointed by the other lenders, they will have to go through a regular resolution process, which is appointing a resolution professional, determining what are the sustainable and unsustainable parts of the debt, whether the company can be liquidated or and go to the IBC, or can it be revived. In case the company is revived and the debt is restructured, the resolution plan will be passed on to an oversight committee, or called the overseeing committee. The guidelines for that are still awaited from the IBA. For dissenting lenders, they will get the liquidation value at the minimum, while they can also exit their position by selling their exposure or transferring their exposure to another lender. One legal source has told us that under the current structure, it is more probable the banks will restructure accounts because they have a 180-day window to sort of push the companies to clean up their books. Whereas, if they found that the company was in a bad position, they would directly go to IBC immediately. Yeah.
Advait, thanks so much for that. You can read those details on BloombergQuint.com as well. Let's go on to the big deal from last evening. HDFC will acquire 51.2% stake in Apollo Munich Health Insurance as it looks to increase its presence in the non-life insurance sector. The entity will be merged with HDFC Ergo upon completion of the deal. HDFC has already bought out Apollo Hospital's stake in the company. Darshan Mehta joins us with the details on the structure.
Yeah, so this is more positive for Apollo, given the fact that what was happening in terms of the debt and the promoter pledge. Now, the group itself, including the promoter and the listed entity of Apollo, will get in 1650 crores. 1350 will be via this 51% stake that they've bought, and another 294 crores because that is what Munich will pay Apollo Group, given the fact that they terminated the agreement. So that's the sense of how this entire deal will happen, and Munich will stay partners, and the balance business will be merged with HDFC Ergo. Now, what will this create? create a large insurance company. It will be the third largest non-life insurance company in the country, at least on the private sector front, with a combined market share in excess of 6.5%. How are the valuations done? In par with what happened with Max Bupa, but at a discount to what Star Health came, because Star Health was obviously a much larger company and a much profitable company. Apollo Munich isn't that much as a Star, but consolidation and synergies will definitely happen. What has the management of Apollo said, and why will they benefit? They had indicated that they want to bring down the debt by 700 crores, so probably this 300 crores will be used to reduce the debt. They had planned to reduce the promoters pledge by 50% in the next 6 months, so the promoters have, after paying tax, will have in excess of 1,000 crores, which will be used for that, and they're committed to release all the pledges by FY20 end, which is something that is the market will take on the positive light.
All right, we caught up with Shobna Kamni, the chairperson at Apollo Munich Health Insurance, to understand what the group plans to do with these funds. Listen in.
This is a strategic exit. We have the ability to deploy wherever there's more shareholder value. So I think that there's enough in India to be able to create more greenfield, to invest, and also to reduce debt. So it will be judicious. The promoters had a pledge. It was a bit too high, and I think that will be reduced.
We also spoke with Ritesh Kumar, Managing Director and CEO at HDFC Ergo General Insurance. Let's listen out what they had to say about the rationale behind the deal.
Fact remains that health insurance as a segment is the fastest growing segment within the general insurance space. And I mean, if we look at the numbers since the time the market the insurance space opened up, while general insurance has been growing at a 17% CAGR, health within that has grown at a 24% CAGR. Our expectations also are that over the next 5 years, health and accident combined will emerge as the largest segment within the general insurance space. We expect significant synergies to come in by way of this deal. The combined market share on accident and health put together adds up to 8.2%. Once the merger is effected, both the entities would benefit from further economies of scale, and that is how the future profitability would improve.
All right, now what are brokerages making of the deal? Darshan is still here on that, Darshan.
Yeah, so majority of them have come out with notes on Apollo Hospitals because that's a bigger deal for them. Macquarie is saying that it's a timely announcement and the stake sale is done at attractive valuations. They've raised the target price to 1,636. Goldman Sachs is saying that from the current 68%, they expect the promoter pledge to come down to 21%. The management has said by the end of the year, it will come down to 0. Morgan Stanley, JP Morgan is also positive. They're saying this entire deal addresses concerns on the pledge and will help to reduce debt at Apollo Hospitals. Similar case from Morgan Stanley, leverage improvement by this deal and addresses major investor concern. Nomura is saying that they expect the pledge to come down from 68% to around 30% and is incrementally positive. And the note that's come out on HDFC, that's CLSA, and they say that the deal will help HDFC expand in the health insurance and synergies will improve the profit for the company.
Darshan, thanks so much for that. India's telecom giants may be forced to lock horns this time for 5G. The government's laid out an ambitious plan to sell spectrum for the new technology, putting telecom operators in a conundrum. Most of them are nursing a huge debt pile, and bidding for new spectrum will only add to it. Sanjay is joining us from Bloomberg News to share how this is going to play out. Sanjay.
So there are 3 elements to it. First is government bid. Government has expressed that they will be going with a spectrum auction, which includes all. Whatever is left, 2G, 3G, 4G, 5G, complete, they will go for spectrum. They would want to raise at least $84 billion. And they're expecting that they can revolutionize the Indian healthcare and Indian education system, etc., etc. That's one bit. That's an expectation bit. And second bit is very important, as you rightly said, 3 leading telecom operators, only 3, which have already a combined debt of around $60 billion. dollars, and any auction, any expenditure is going to strain their balance sheet further. So that is, but they can't stay away from it, and of course they have an option to bid it at a later date, but it's going to be expensive. Whether how they are bidding, what will be the pricing, whether they will bid aggressively or not, or someone will stay back for a later date. One will have to wait and watch. And for consumer, what will bring 5G? What will bring to them? Any meaningful change, they will have to wait at least for from 1.5 to 2 years to get a meaningful change. Whether the cost will justify, because if you have 5G, that whether you will have to change a handset or not, how the cost will be justified, one will have to wait and watch. And very interestingly, 5G is going to be the next theme for Indian telecom industry.
All right, so change in that industry will continue. Sanjay, thanks for that. That's actually a wrap on this edition of Power Lunch. Thanks for watching.